Hey, it is 9 o'clock.
Okay, well, let's begin our meeting. And let's begin with the roll call, I believe.
Jerry Abrahams,
Here.
Phil DeFronzo, Timothy Hodges, Catherine McKinnon, Commissioner Perez, Franklin Perry, Chelsea Ross, Sarah Sanders.
Here.
We do not have a quorum for this meeting unless you wait for another 10 seconds until Commissioner
Well, all we
Perez
have is
and Franklin
reports
Perry are
until
here.
the minutes at the end. So
Very
Yeah,
good.
we do have Commissioner Perez just joined and Franklin Perry and Phil.
There we go. So if I can just for roll call go back and call Phil DeFronzo.
Here.
Thank you. Commissioner Perez.
I'm here.
Thank you. Franklin Perry.
Here.
Thank you. Now we do have a quorum for the meeting.
thank you. Okay, good morning, everyone. We have a series of reports and then the minutes, so mostly reports today. And the first item is a report of the 2025 Series C bond issue. Over to Hazib.
Thank you. Good morning, everybody. This month we closed the second single-family bond deal, the 2025 Series C bonds, and that structure consists of 270 million of fixed rate bonds led by Wells Fargo and 80 million of variable rate bonds underwritten by RBC. Here in the room we have Nick Fleur, the housing group head for Wells Fargo, and he's going to talk about what transpired and how the sale went. So Nick.
Great, thank you, Hazim, and I appreciate being in front of you all. As Hazim mentioned, on May 27th and 28th, we actually brought $20 million of tax-exempt bonds for CHFA, as well as $250 million of taxable debt. I think you're all familiar that we've seen a lot of volatility in the markets of late. The federal government's tariff policy, kind of on again, off again, has unsettled the markets. The week prior to our pricing, there was talk of the tax bill, which caused worries about increasing the federal deficit, which caused treasuries to really approach their year-to-date highs, as well as, I would say, some investor unease in that typically we see treasuries oftentimes is the flight to safety, if you will. And I think that given the government's stance, we're not seeing quite the same reactions that we would typically see with conflicts in Ukraine, even of late conflicts in Iran, et cetera. And that coupled with, as I think everybody's familiar, Moody's downgraded the federal government from its AAA status. So now matching S&P in kind of not being the highest credit quality that they had enjoyed in the past. The week of pricing was the week of Memorial Day as well, so that caused a little bit of a compression, if you will, in terms of the number of deals that were compressed into really 3 pricing days instead of the normal 4 pricing days. So that said, to get full focus, I know that in the past, oftentimes Connecticut has been able to accelerate and do the whole transaction in a single day. We kind of, given the holiday, et cetera, ended up doing a full retail order period on the first day. I think that was highly successful. Again, given $20 million of bonds in Connecticut for, as you know, retail buyers, we had a very strong reception, over subscription, and we're able to lower the tax exempt yields quite significantly. The taxable bonds were a little harder slog, I would say, in terms of we had good demand at the front end. We had good demand at the long end. It's interesting that we're seeing with PAC bonds, which I think is, you guys are, again, probably familiar. It's a bond that is sold to an average life. And what we're seeing from these PAC buyers is that they're getting, with the potential of being accelerated or extended. Buyers are much more focused on pack bands, pack spreads, et cetera. They're delving into that a little more. And as a consequence, they're penalizing some issuers who are not meeting their pack tables. And that means when I say penalize, they're asking for higher yields. And what that does in the market, oftentimes, if you have, if you have a transaction that's sold at, say, plus 125 basis points to the, 5-year treasury, those investors will come back, and even though Connecticut has met their pack bands and everything, they'll say, hey, well, that's where Maryland traded last week. We should be at 125. So it becomes very difficult to push through and, convince investors to come in. That said, we were able to, market the pack very effectively. The interesting thing, I think, on the taxable series was that we had an investor who asked for a lockout. And again, in the intermediate area of the curve was where we had the fewest buyers. By providing a lockout from calls to that investor, we were able to get them to come in without having to adjust yield significantly. I know the board and Jerry, you specifically in the past have asked about spreads relative to, other CHFA transactions.
Oh, Lorraine, can you move the page to the one that shows the chart, which is page 22?
21 and 22.
21 and 22. Yep.
Great. So, obviously, as you guys have talked about in the past, you have different markets, different, there are world events that cause spreads to adjust and change. Our transaction is kind of the bright blue in line there, so that you can see relative to other, former CHFA issues. We did achieve, fairly tight spreads or tighter spreads than maybe some of the prior transactions. Not the all-time lows by any means, but I think it's a good trend in terms of where we're seeing those spreads go.
This was the yellow line. Your taxables was the 2025 C2s, correct?
Yeah, I'm sorry. Yes.
Right. Okay. I thought you were saying that the light blue was your deal.
Yeah. No, I looked at the So
we're the yellow. So yeah.
Yeah. And so this is the taxing. Oh,
these are taxables.
These are the taxables. Yeah.
Right.
Sorry. I was looking at the.
Yeah. So these are the ones that struggled, which makes sense.
Right.
I mean, you look at your like 1x and you struggle. Look, and I think Nick, I think you guys do a great job for us. So, your performance has been really good. This deal, obviously, the taxables struggled here, as you can see a little bit, and you can see it also in your in the how oversubscribed were, the front ends were like right on. So that all makes sense to me. I guess I don't understand, like, on the back end, and maybe because I don't understand the pack bonds, given we were so oversubscribed, why we couldn't do maybe a little better on the back end a little bit with the pack bonds, because it looks like we're really oversubscribed. Like, you don't want to see be really oversubscribed and a little cheap, which is kind of what we did here. And again, I want to put in the context, I think you guys did a great job.
Yeah, no, I appreciate that. And I think what we did struggle with, frankly, is, as I mentioned, some of the prior weeks pack sales, there was one that went out considerably wider than where, we ended up, say, 10 basis points through where the other, very strong HFA that ended up being at plus, 125 versus our plus 115, as I recall. And it's just 10 basis points, as you can probably appreciate in the pack market, is a pretty big differential.
And that's in yield, so was it like a half a point in price maybe or something? Who knows?
So
yeah, and then sometimes when you look at that oversubscription, it can be somewhat misleading, because before we were oversubscribed, we were trying to get investor to come in, and when they did come in, they would put in a much bigger order. So so it's more like that quantity versus the.
Yeah, and they're always going to be oversubscribed because you're not, it's like, I get that, because no one's going to, the bonds have to, they have to go out, and you have to be a little cheap to get this primary market. You got to get them interested. 100% understand that.
Yeah.
So, the whole point of this chart is not to really necessarily, drill down on any given deal's performance, but rather gives the authority. I think we've taken the context. see where we're doing over time.
Yeah, yeah.
So, and
absolutely.
that's, it's not say, okay, well, this was, and look, and
Right.
market conditions will be what market conditions are, and you're gonna be, you know, like my
Right.
golf score, it's not always gonna be
Right.
good. And so relative to the others, so I mean, it's like, it just, the whole point is just to have that range. I mean, but it's just the data point that we build over time.
Is the pack on here?
The pack,
On
I should
the
look
thing?
at, it's,
No.
it shouldn't, no, because
No.
it was at 125, which.
Yeah.
Or
So these are
115,
just- so
sorry.
these-
This is just a term.
This is
This
just
is
the
just-
term box.
You
right?
do this.
Yeah, the cereal.
Cereal.
The cereals. Just the cereals. And the cereals is where you showed that you were all at one, you know, that's
Right.
the front end of the taxable front end of the curve is always gonna be problematic.
Yeah.
Because there's just not that many buyers for that. You're always gonna be one time. So that you're kind of like again, I care if we're gonna be for cheap and oversubscribed.
Right.
But we weren't on, I assume on the cereals, we were all like one time.
Yeah, I mean, if you want to go to the, I guess it's page 20, you can see some of the prior transactions, taxable spreads. You can see that really Connecticut did outperform really any of the other HFAs that were, you know, in the market near the same time in terms of spreads to treasuries.
And using your example, like if you're talking about the golf score, if you're playing the same course all the time,
Score will still vary.
That's my point. so you can essentially use the different golf courses, equates it to the different market conditions. So depending to where Treasury was at the time, and then when you're trying to say spread to Treasuries, right? So if interest rate was like 5, the spread to Treasury at 5 versus spread to Treasury when interest rate is at 4. So you do have that dynamic.
Right, well, when rates are lower, you're gonna tend to get more spread compression. So as rates go up, we should expect our spreads to treasuries to widen.
So that's my point. Like when you look at the chart, it only, you know,
Yeah.
assume everyone is.
I have
using-
never said the
yeah.
chart should
No,
be
no,
say,
no.
oh,
I know, I'm just.
your spreads are high, you know, that's a strike against you. I've
Yeah.
never said we should ever use it like that.
Okay.
I like the golf analogy, but it's also the weather, you know, it's the weather. What the weather's like, how that affects your golf.
Right, absolutely. So it is very clear that it is very hard, even when you try to compare pricing year over year at the same time, you know, during either before the tax season or after the tax season. Every year is different.
Yeah, but I think you're supposed to, I 100% agree, but I think we're supposed to have those discussions about why and all that kind of stuff. Yeah, I mean, probably also this Memorial Day weekend and,
Yeah.
you know, and, you know, just general conditions. So I'm not surprised at that. But it's a pretty big, if you look from the high to the low, I mean, it's 50 basis points more almost. So it's a lot, you know, and we've done the cereals. I mean, the problem is on the cereals, probably the economic impact is not that much. You really care about your PAC bonds and your term bonds.
Yeah, I mean, the PAC bond, for example, in this deal was over $80 million because of the size of the taxable relative to the tax exempt. So, I mean, that's another issue that does definitely figure into marketing because clearly that's a lot of bonds to digest. The PAC field is fairly limited in terms of the number of buyers.
And the tax exempts are great. I mean, the tax exempts.
Yeah, sorry, that was the chart I was looking at. When I
Yeah,
first,
execution was great. Yeah.
But
Only
that's
20 million
again,
though.
size, 20 million, yeah. that-
20 million. Like we got it done even by 11 o'clock in the morning.
Yeah, I mean, I think we had just under $80 million of retail orders for the, you know, $20 million.
So it's easier. Yes, it's much easier to sell.
I
Yeah.
think what strikes me is the size of the taxable. You know, it's so much larger than the tax exempt because of pressure on volume cap and the availability or lack thereof of
Yeah.
prepayment refunding authority.
Yeah.
Yep.
No, and I think that is a bright spot in the market of late, just not that people have to go to taxable, but more specifically that we have the buyer base for taxable HFA bonds, I think has been pretty robust in terms of the reception that we've had. A lot of HFAs, even those HFAs that you wouldn't have thought would have been volume cap constrained or having to issue taxable debt. So. Happy to address any other questions, but we appreciated the opportunity and
Thank you, Nick. Any questions? Okay, we're on to financial reports with Hazim.
Okay, so just to let everybody know, Allison is out today, so I will be presenting on her behalf. So through the end of May, mortgage loan and interest revenues, investment interest revenues are approximately 11.3 million over budget, and about 21.6 million higher than the prior year. The bulk of the variance is attributed to investment income. As everybody know, that year over year, the portfolio has been growing, specifically due to the homeownership program and the increase in mortgage-backed securities. When it comes to expenses, we do see the corresponding increase where interest expense is 3.1 million above budget and 19 million higher than the prior year. Outstanding bonds, 706 million higher, same time last year. And servicing fee, about 2.1 million above budget through the end of May. For the admin expenses, we are currently 3.5 million below budget and 436,000 compared to the prior year. When you exclude salaries and benefits, which is about 12.4 million, the current year-to-date expenses are about 53,000 lower than the prior year. In terms of the net position, we are currently above target by 12.1 million. I'll be happy to answer any questions regarding the financial reports. Oh, Commissioner Perez.
I think I know the answer, but I've learned after many years in accounting not to make assumptions. The line item for interest expense is higher than budgeted. Can you expand on that a little bit more?
Yeah, so two things that's going on there. So number one, of course, has something to do with the fact that we are selling more bonds, but more importantly, we're selling more taxable bonds. So due to the increase in interest rate and the volume to fund our production, the interest expense is currently above budget.
How much more taxable bonds in particular have we sold in, say, last year? And I mean, and we should have expected that when we did the budget because of the market conditions.
It's not really market condition per se. I mean, some of it is something to do also with the fact that we thought that, and again, there's so many variables. Number one was we thought that the interest rate would be somewhat less higher than what we projected, of which then it would allow for an increase in refinancing and prepayments. That situation would provide us the opportunity to recycle and use those prepayments for home ownership. And then, so that did not happen. The second thing, what we are experiencing today is an increase in demand in the multifamily production, where they are seeking and need tax-exempt capacity to generate the tax credits, of which we then had to switch, and instead of relying on tax-exempt, we have to use taxable debt. So relatively speaking, when we sold the first bond deal for single family of the year, when we sold 200 million of taxable, that was in fact the largest taxable that we sold for a program fixed rate. And then this time around, we just sold another 270 million of taxable. So that's essentially the main driver.
Okay, so let me understand this better. So use either one, doesn't matter to me. What was it that you projected the rate was going to be, and what the rate ended up being?
So when we projected the rate for the budget, I believe it's about like 20 basis points lower overall for the year. And then in terms of the volume, we projected we projected about 750 million of issuance for the whole year. So we think we probably will issue 900 million this year.
You know, I would appreciate if you could do an analysis and very, very high level. You don't have to spend a lot of time on it, you know, and do the math that if you're coming in 20 basis point higher than you projected, and do the math about how much higher and you're doing the bonds, that the numbers work out to make sure it's not other stuff like fees or other things that are, you know.
Oh, no, yeah,
well,
no.
That won't show up in the interest line. That will not show up in the interest line.
Correct. Right. No. I can tell you right now that it's just bond interest because we do have different line items to pay for those.
I corrected myself.
fees.
myself.
Yeah. Okay.
But you know, appreciate if you do that simple, you know.
Sure.
Nazim, does that have anything to do with the schedule of financings that you project in the budget versus actual schedule? In other words, one assumes periodic issuances, but the issuance schedule may vary based on market conditions.
Yeah, somewhat, but you know, so what's going to happen is like this is the report through the end of May. We just closed this deal, so when you see in June, then you'll see a wider variant.
Yeah.
But the key point is if you look between the revenues and expenses, where the portfolio is 700, you know, just close to 730 million higher than last year, and then when you look at the bonds, it's 700 million higher than prior year. So that's the corresponding increase. So pretty much the main driver is we made a projection in terms of how and where interest rate was going to be based on a certain amount of volume. But when you have interest rate being higher, which has helped the interest income, but also continue to show a higher increase in interest expense, we also are seeing higher volume. But Commissioner, yes, we can show.
Yeah. My advice in the future: listen to the Powell side of the equation and not the Trump side of the equation.
Understood.
Because he's saying rates are not going to go lower anytime soon. I don't mean the next few months, meaning back then, versus the president was saying, day one, we're going to lower the rate and we're going to do all this other wonderful stuff.
Right.
Thank you.
Sure.
I have a question about volume cap. Didn't we have a legislative proposal to secure more volume cap up front? And my recollection is that didn't go forward. Did we actually put that forward and did it not go forward? Is that correct?
Yeah, Sarah, this is Nandini. It did not go forward. We've had some conversations with the Office of Policy and Management. I think their preference would be not to have done this legislatively. So we're trying to have, you know, some more productive conversations around how we can collectively manage our demand for affordable housing and other needs for the state. So those conversations are continuing.
Any other questions for Hazim or comments? Seeing none, let's move on to production and delinquency reports. John Chilson.
Good morning. The month of May, the authority purchased 217 loans totaling $59 million. Comparing that to May of 2024, that's 15 fewer loans, but only $1.3 million in dollar value, and that's due to the overall increase in the average loan size by 5% over 2024. 95% of May's production was securitized, which 207 loans totaling $56 million. The remaining 10 loans totaling a little over $3 million were whole loans. The end of May mortgage-backed security portfolio balance was $3.8 billion. That's $38 million more than April. And the whole loan portfolio through April declined by 38 loans, roughly $5 million, ending with a portfolio balance of $1 billion. The whole loan delinquency rate decreased month over month by 17 basis points at 5.09%, which continues to trend below the state and nationwide averages. And the carrying balance of loans in foreclosure year over year has changed very little. It's down $443,000 to $11.8 million, and with six less foreclosure loans. Loans less in foreclosure. For the month of May, the authority also funded 65 down payment assistance loans totaling $765,000, an average loan value $11,800, and 204 time to own forgivable loans at $4.6 million, an average loan size of $22,700. In our multifamily portfolio, there were 5 new loan closings, increasing the portfolio by a net of 2 to 610 loans totaling $1.5 billion. There were 7 permanent loan delinquencies, no construction loan delinquencies, and the overall delinquency rate was less than 0.5%. I'm happy to answer any questions.
Any questions for John? Seeing none, we'll move on to Joyce Campy for the internal audit report.
Good morning. I'd like to provide you with an update on internal audit activity for the first half of the year. The plan has 3 categories. It includes audits of internal controls over CHFA business functions, compliance reviews of single-family loan servicers, and advisory services at the request of management. Starting with CHFA audits. For the multifamily business, we're continuing our coverage from last year of the HTCC program. During the period, we completed a follow-up audit of the compliance monitoring of the program. Our work focused on ensuring that recommendations from the original audit issued in 2022 were implemented. Results concluded that primary all or 23 prior audit recommendations were implemented. 2 new recommendations were made to further improve the review of housing program documentation. And the audit report is attached to this report. Audits of payroll, administration, and the payment of fringe benefits, as well as multifamily cost certification, business functions are in process. Turning now to servicer compliance reviews. The scope of these reviews include homeowner mortgage loan servicing and collection functions outsourced to loan servicers. The audit plan includes 3 cyclical reviews. During the period, a review of Key Bank National Association was completed. The bank services approximately 4% of the authority's single-family first mortgage loans. A review letter was issued and servicer management response was reviewed. A review of Amerinet was also completed. The organization services approximately 28% of the authority's single-family first mortgage loans, and they are the authority's largest servicer in terms of dollars. A review letter was issued, and management's response was received this morning and is being reviewed. A review of Capital for Change is in process. In addition to a review of the first mortgage loans, the scope of our review will include the servicing of loans of Capital for Change of subordinate mortgage loans. That includes loans they service for the DAP program and the time to own forgivable loan program. Now, the plan also includes follow-up reviews of 2 additional servicers based on their 2024 results. And I'd like to provide you with an update on the status of servicers' corrective actions. Starting with the McHugh Mortgage Company, which services approximately 25% of the first mortgage loans. They are the largest servicer in terms of volume. We completed a limited scope review to follow up on certain conditions cited in our review letter of May of 2024 relating to CHFA's custodial bank account. As previously discussed, the authority's principal and interest and borrower's escrow account funds were consolidated into one account. Borrower's escrows were funded from this account rather than the servicer's corporate account, resulting in a shortage in the account. Our review test results performed in 2025, indicated that a separate custodial bank account was established for escrow funds. The adjusted bank escrow account balance as of January 31st, 2025, properly reflected borrowers' positive escrow account balances and suspense funds. And approximately 1.706 million had been advanced from the servicer's corporate account to fund borrowers' negative escrows. McHugh also provided procedures that they're following to fund negative escrows going forward. Procedures require that an escrow advance or recovery of funds to be made to from the corporate account following their month-end reconciliation. As a frame of reference, other CHFA servicers advance these funds daily from their corporate account. Turning now to Norcom Mortgage, which services approximately 13% of the first mortgage loans. As previously discussed, a review of Norcom Mortgage was performed and a review letter was issued last October. Since the original review, a corrective plan and periodic updates have been received. Basically, they're indicating that work is being done, but more time is needed to correct the issues identified. Management provided evidence that deposits were made in February and March of 2025 to fund the shortage in the borrower's custodial escrow account based on servicers' records as of January 31st, 2025. However, at this time, given the fact that items are still being worked on, we are unable to verify that all conditions have been fully addressed and processes and controls have been put into place to prevent these items from reoccurring. We continue to follow up with the servicer on the status of review letter conditions and provide updates to CHFA management. In terms of advisory services, we continue to monitor implementation of IT security controls to further mitigate cybersecurity risks and enhance controls, and are reviewing documentation as it becomes available. This project is based on an assessment of IT controls performed by management that was completed based on best practices from the Center of Internet Security, or CIS. CIS controls are based on NIST, which you may be more familiar with, which is the National Institute of Standards and Technology. CIS has 18 top-level controls that they view as best practices with very detailed specific safeguards underneath each control. During the period, we reviewed and provided comments on certain draft IT policy statements, such as backup and recovery, to ensure that processes and controls outlined in the policies align with CIS controls and safeguards. And lastly, we continue to participate as members on various authority-wide committees as detailed in the plan. The next documents in the report are the updated audit chart based on current statuses I've just described, as well as the HTCC program follow-up audit report. And with that, I'd be happy to answer any questions.
Commissioner Press?
Yes, I have a question and then a request. On your, and this all had to do with mortgage servicers portion of your report. On the McHugh part, are you satisfied with the improvements? Are there
Yes,
any
we are
other
satisfied with the
issues?
Yes.
So now, can you, so that's the question. So
Yeah.
the ask is, can you provide me with a copy of your review letter for the entities that you did?
Yes.
So I could use that as, you know, to compare it to what we find when we go out, and I could,
Absolutely.
you know, develop trends, you know? And I can see trends. So when we go out to examinations, you know, if there's a trend with escrows issues, then I know to direct my people that no matter who the company is, we won't, you know, we're definitely going to look at escrows, right? If there's a trend with whatever the issue may be, you know, it will help
Okay.
us develop our examination plans.
Absolutely.
Thank you.
Any other questions? Comments? Seeing none, we'll move on to approval of the minutes of the Finance and Audit Committee meeting on April 24th, 2025. May I have a motion?
I'll
So
move.
move. Oh, I'll second it. This is
Second, thank you,
George.
Commissioner. Verbal vote, all in favor, say aye. Aye.
Aye.
Any opposed? Any abstaining? Okay, it passes on a verbal vote. I just have one more follow-up question on the volume cap and the issuance of taxable. I know a volume cap goes to the bond commission every December, as I recall, for allocation and reallocation. So does the timing of your taxable, how does it coincide with the calendar and the allocation of volume cap? Like if you could respond to that, Hazim.
Sure. So based on current practice, issuers or quasi issuers that do receive allocation from the state for volume cap, they will get a letter from OPM to submit a response to them, typically no later than the end of October.
Okay.
And to describe the remaining allocation and what they have used it for, and if they do have any remaining allocation, what they would like to happen or put in a request, whether or not they would need to receive the carry forward. They also would ask their quasi to describe their needs of volume cap in the future. So that's typically the trend. The idea would be that OPM, after receiving those letters, they would then plan and provide a proposal, or I guess make a determination at the last bond commission meeting. So that's how the December date comes into play. But I would say that there have been times before the current administration that they did move the date earlier. So there was a time when there wasn't a bond commission meeting in December. They made the determination in November. And when they did that, they did ask CHFA to submit a response earlier, like in early October kind of thing. So it all comes down to what OPM decides in terms of the planning. So that's one thing that we are always different. Bless you. And then in terms of like how we manage our processes, so every year we would go through the process of identifying the amount of recycling we would have. And then we have a projection in terms of what multifamily deals that is currently in the pipeline, because we know that multifamily needs it more than homeownership due to the tax credit. So there is somewhat of a priority there. But then at the same time, as multifamily deals, they do take much longer to bake. So there'll be some years when we have some set aside for multifamily, but because something happened or whatever that may be, then we would divert the volume cap allocation to homeownership. So having that and then overlay CHFA needs when we have an active homeownership production where we have continuous funding, we then determine when would be the appropriate time to sell bonds. So if you look at, say for the last 5 to 10 years, we generally would sell between 3 to 4 times for single family. And then we try to slot it in in every quarter if we are able to. But we are also very sensitive to the last bond deal of the year, just because we know that OPM will be seeking and trying to understand whether or not we have volume cap. And when you have scarcity, you try to do the best you can.
Okay, it's just that this last sale had such a heavy weighting of taxable, and so I'm kind of questioning, could you better spread it out throughout the year so you're not having so much in the market at once, or do you think?
No, Absolutely. So I think, so like I mentioned to the commissioner earlier, we right now are projecting that we probably would purchase around 900+ million of bonds for homeownership. Last year it was about $1 billion. So if you take whether it's 900 million or $1 billion, you split it 3 ways, you still have about 300 million, give or take, to sell if you sell 3 times a year. And then you have multifamily, and we have a handful of projects in the pipeline that, based on the feedback we receive from them, they would like to close before year end. And based on what we know today, if we try to close all of them, we will not have enough volume cap to fund all of them this year. So there'll be some risk management that we have to take, where the one that we can fund this year, we would fund this year. But those that, if they do close this year, we probably, well, not say we will punt to the following year to effectively provide the final funding for those multifamily projects. So the fact that we are more taxable heavy is because we're trying to preserve our volume cap capacity to ensure that we can make it available for multifamily. Because for homeownership, we have a bit more flexibility because they don't need it. But the way we have done so has been to blend with tax exempt. So for the deal in question, the 2025C, for example, only 47 million of the tax exempt portion of the 100 million came from new volume cap. The remaining 53% or 53 million actually came from recycling. So
Okay.
we do build in this philosophy where we would prioritize using recycling if we can, and then defer using the new volume cap because we want to make it first available to multifamily. But as you know, when we are working with multifamily development, they all want to close yesterday. And we try to do our best, trying to make sure that when we do access the market and when we do deploy the resources, we do it as effective as possible. But then there have been instances in the past when we did reserve volume cap for multifamily, and then for whatever reason they couldn't close. So we would pivot and essentially reallocate volume cap that we had for homeownership.
Yeah, I think the process through which we return unused volume cap to the state and then have it reallocated back to us is really sort of where, you know, we know we have the need, you know, we just, there's just not an easy way for CHFA to carry forward. We have to return it to the state and have it come back to us. And that's always a little bit, I don't want to use the word like delicate, but just, we have to manage that. So we want to make sure that they understand that we have pipeline projects and we have loans ready to be securitized and funded. It's just, you know, they may not be quite prime time ready, but it's going to happen.
Is that a function of state statute or just the way the federal?
No, it's state statute. So it's written in the state where the state is the entity that direct and allocate. So even for the carry forward, we do not have the ability to carry forward without an authority or an instruction from
the reallocations
from the state.
Hmm.
So we are also sensitive that the other quasis, those that do use volume cap, they have their own needs. And we don't want to get into this tug of war and send it back to OPM and then somehow, you know, who can make the case better in terms of what would be the best use, even though we always say that housing, you know, trumps everything else. But again, whenever that we can reduce the uncertainty, that will be best for CHFA because we run a very complex but efficient operation.
Who are the other big users of allocation?
The Tesla, and then the municipals.
Municipals or IDDs, I guess, or something.
No,
No, for housing.
local
Just
housing.
Oh, local
Yeah,
housing.
Yeah.
That's your problem.
I didn't say that.
So you guess
Any
you
other
should-
questions or discussion items? Hearing none, I'll have a motion to adjourn. All in favor?
Aye.
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 You sound so enthusiastic. Okay. And we'll see you at the next meeting, board meeting.
Okay, thank you.
Thank you. No, I agree. I think it